Okay, so good morning, guys. We're here for week 3 of youth financial literacy. And today we are going to learn about understanding credit scoring. And this is module 6 of the Freddie Mac Credit Smart. Again, my name is Andy Everett. I am the County Extension Agent in El Paso County for Prairie View A&M University Cooperative Extension Program. Today, the module is going to, start my video. The module's set up for you guys to understand the process of credit scoring and the various scoring factors. It will describe credit scoring from a borrower's perspective and illustrate how your behavior as a consumer affects your credit scores. And it will also provide you guys as participants with some tips on how to potentially improve your credit score over time. Okay, so after completing this lesson, we want you to be able to define credit score, explain how credit scores are determined, and use tips and techniques to improve your credit score over time. And so the topics that we'll be covering today are: what is credit scoring, factors that influence credit scores, how to obtain your credit score, and how to improve your credit score. Okay. So we'll start off with what is credit scoring. So just some basics to cover. A credit score is a numerical rating used by lenders in the loan approval decision process. Credit scoring uses statistical models to evaluate credit risk by comparing credit information about a consumer to the credit performance of others with similar credit reports. Okay. Credit bureaus keep track of everyone's credit history information and things like how many credit cards you have and how much you owe and whether you pay your bills on time, where you work, and for how long. So credit scores may also be used to determine the interest rate you get on a loan. And by using credit scores, lenders and creditors treat each person objectively because the same standards apply to everyone. Okay. Credit scores do not include race, religion, national origin, gender, or marital status as factors. Okay, and just to get started, I'm going to ask you guys a couple questions. So first of all, do you know the range of what a credit score, the numerical value? Go ahead and unmute yourself if you want to answer the question on what you think would be considered a good credit score.
820, I think, is the highest.
820, yes. Okay. Anybody else? So, I'm sorry?
Good job, Jacob.
Yeah, so that's the highest credit score that you can have. There has to be a number of factors for you to be able to maintain that level of score. But for the most part, you're really striving for something in the 700s. 700 and above is what's really going to get you the best interest rates, okay? And then as we've already been going through this program for a long time, can you guys name some ways that you could improve your credit score?
By buying inexpensive items. What else? Well, when buying a car, using I guess using the right car loans, I guess. I like that.
Maybe what you're trying to say is when you get a car loan, getting a car loan at a low interest rate?
Yes.
Okay. But as far as if it's improving your credit score in order to secure a loan that's at a good rate, what would you guys do? What's the number one thing that I tell you guys all the time?
Do not buy expensive. Oh,
Pay
sorry.
your bills on time, right?
Oh, yes.
Pay your
And
bills on time. Okay, that's the one thing I want you guys to get out of this, okay? So remember that for next time. Okay, so here it's talking about credit scoring, right? And we talked about the basics of how they evaluate that, how they're on credit reports. And so the ultimate output of these statistical models is your credit score. Well, these things are determined by certain things. And some of the terms that I want you guys to be familiar with are credit risk. And credit risk is a term within the credit industry to refer to the level of risk or likelihood of an individual's borrower's future or potential default. So where do you fall along that credit risk line? Do you have a lower credit score? That's going to make you at a higher risk. If you have a higher credit score, that's going to make you less of a credit risk, right? And then credit reports. A credit report provides a history of your use of credit. It's specifically, it's a file maintained by a credit reporting agency that contains information about a person, such as where the individual works and lives, information reported to the credit reporting agency by the creditors regarding money borrowed and payments made, and public record information such as whether the person has filed for bankruptcy. And, and then just a definition of credit score, again, is a numerical value determined by a statistical model based upon past credit behaviors, which predicts the likelihood of future loan default. Okay. So, credit scores. Credit scores are used along with your credit report and other information for your loan or credit application to determine your eligibility for a loan. Credit scores speed up the loan approval process. And just as with your credit and credit behavior, credit scores change over time. Okay, so your credit score can impact your ability to get a credit card, purchase a home, borrow money, and whether or not you can get service from utility companies. Remember we talked about that? We talked about that if your credit score was real low and they knew that you didn't make your payments on time, you might not be able to get it at all, or in order to get services, you're going to have to pay a pretty high deposit to get that, okay? So that's just, trying to get utilities at your house and you have a low credit score, you're going to have to pay like 2 months worth of bills with a deposit so that they're able to recoup their money just in case you take off on them. They have that money, okay? So some of the terms here are loan, again, the money you borrow from a financial institution with a written promise to pay it back later. With a loan, financial institutions will charge you fees and interest to borrow the money. We have interest rate. Interest rates are commonly thought of as the cost of borrowing money. The interest rate is expressed as a percentage. The amount of interest that is paid each year is determined by multiplying the amount of the loan by the percentage. So we've talked about it several times that your interest rate is going to be dependent on your credit history, your credit behavior, your credit score. The better credit behavior you have, the better credit history you have, the better credit score you have, the lower your interest rate is going to be. And if you have one of those really high scores like an 820, you might even be able to secure a loan at 0% interest. So it's in your best interest, because if you're paying something with a really high interest, you're only paying the interest. You're not paying down that loan. So you're paying to get that loan, but it's going to take you so much longer, and you end up paying twice, 3 times, 4 times the amount of what the product that you're buying, a car, a house, whatever it is, you're paying that much more if your interest rate is that much higher, okay? And then the lender, so is the term used for the person or entity that is providing credit or loan to a borrower, and then that comes with specific terms and conditions, and the term lender can generally be used interchangeably with the term creditor, okay? Again, creditor is a term used for the person or entity that is providing credit or a loan to a borrower at those specific terms and conditions, and vice versa with the term lender, okay? Okay, so let's talk about factors that influence your credit score. So this topic is going to discuss the 5 primary factors used to determine credit scores. So credit scores are based on information contained in your credit report. Last week we talked about credit report, right? So there are 5 primary factors used to determine credit scores. Income level is not a factor in calculating a credit score, okay? So the 5 factors are your payment history, the amount of debt you owe, how long you've been using credit, how often you applied for a new credit card and taken on new debt, and the types of credit you currently use, such as credit cards, retail accounts, installment loans, finance company accounts, and mortgages, okay? So it's important to note that your income level is not a factor considered in calculating your credit score. These are the factors that influence your credit score, okay? Okay, so we have, there's an action on the left-hand side and an impact or no impact on the right-hand side. So you guys are going to tell me what your answers are for the action on what kind of impact. So paying late, what do you think the impact, would it have an impact or no impact? Impact, right? That's the most important thing, right? So 35% of your credit score is your payment history, okay? So consistently being late on your credit card payments will hurt your credit score, okay? Pay your credit card bills on time to preserve your credit score. So bank overdrafts, do you think that it has an impact on your credit score? Bank overdrafts.
Yes.
Okay. Actually, it doesn't have an impact, okay?
Oh.
Overdrafting your bank account can get expensive, especially if you have several overdraft transactions, but those overdrafts won't hurt your credit score as long as you settle them before they go to collections. But if your account remains overdrafted and your bank ends up sending your account to a collection agency, your credit score will take a hit, okay? But that's not going to hurt your credit score, but that could hurt you in securing a loan, okay? So a lot of times when you're working with a lender or a creditor, say you want to take out a business loan, if they're going to ask for your bank statements, and they're going to see that if you've had any type of bank overdrafts, because that shows that you're not being able to manage your money correctly. So even though it doesn't impact your credit score, it will impact you depending on what type of lender you're using and if they want that information from you. So either way, it's not a good idea to have bank overdrafts. You should have those safety features where they can connect to your savings account so that you have that overdraft protection, okay? Okay, so income. Do you think that has an impact? Impact or no impact?
Impact.
Impact, right? You think it has an impact?
No.
Okay, so right, we said no impact, right? So while the information about your employer may be listed on your credit report, your income is not. So having high or low salary won't directly impact your credit score. So for example, a high salary won't boost your credit score, nor will a low salary drag your score down, okay? But your salary might influence how you pay your bills, and that is included in your credit score. So if you're living past your means and you're not paying your payments on time and you're not able to pay those, then that's going to impact your credit score. But just your salary or just if it's high or low, that's not directly going to impact it, okay? So not paying at all. Do you think that has an impact or no impact?
Impact.
Impact, right? Okay, so completely ignoring your credit card bill is much worse than paying late. Each month you miss a credit card payment, you're 1 month closer to having the amount charged off, okay? So having an account charged off is impact or no impact?
What is
Having an account charged.
And having an impact charged off is ignoring your fees? Is that what it is?
Having an account charged off means that it's already been sent to collections. Do you think that that's going to have an impact or no impact?
Impact.
Okay. So when creditors think you're not going to pay your credit card bills at all, they charge off your account. This account status is one of the worst things for your credit score. Okay. So next one, having an account sent to collections.
You can see.
Impact or no impact?
Impact.
Impact, right? This is another way of saying that. So creditors often use third-party debt collectors to try to collect payment from you, and creditors might send your account to collections before or after charging it off. Okay. Okay. So I'm sorry, I misspoke there. So charging off is just saying that you're not going to be able to make any more purchases on that credit card anymore. So they kind of cut off your credit card, and they haven't sent it to collections, but you're in that limbo, right? So they charge off that account. And before they send it to collections. So both have an impact. But having an account sent to collections using those third-party debt collectors, the collection status shows that the creditor gave up trying to get payment from you, and they hired somebody else to do it. What do you think about insurance payment? Does that have an impact or no impact?
Impact.
Anybody else? Okay, so that actually has no impact. Insurance companies check your credit score to decide whether to insure you and to collect your insurance premium. Even though they use your credit score to make decisions about you, they don't report your timely or untimely payments to the credit bureaus. Insurance payments won't affect your credit score. What about child support and alimony? Impact or no impact?
I don't know.
Okay. Anybody else? Impact or no impact?
Impact.
Okay. Impact? Okay. It's actually no impact. So child support and alimony payments won't affect your credit score unless you fall behind on your payments and a collection agency has to get involved. In that case, your credit score could drop significantly. So this is only if you're really being sent to collections for that. And I'm not sure if Texas does anything like that. I know that they'll, you can go to jail and stuff for not paying your child support. An alimony. Texas is not an alimony state, so that doesn't apply in Texas. Utility and cell phone payments. What do you think? Impact or no impact?
Impact.
Okay, so no impact. Like insurance companies, many utility service and cell phone providers check your credit score before giving you service, but neither of these businesses provides your payment information to credit bureaus. So your credit score isn't helped by timely payments on your utility or cell phone bills. However, if your account becomes past due, it may be passed on to a collection agency who would list the account on your credit report, leading to a drop in your credit score. So a lot of these things like the insurance payments and child support, utility and cell phones, they have no impact if you're paying on time, but if you stop paying, then they will have an impact, okay? Because then you're going to be sent to collections, okay? But that's not a way to build your credit. You always want to make your payments on time and get into that habit of making payments on time, but they're not going to help you build your credit by paying those payments on time. If you know what I mean, like that's not a way to build your credit, but you still should pay your payments on time, okay? Defaulting on a loan. What do you guys think? Impact or no impact?
Impact.
Okay. Yes, that's correct. Loan defaults are similar to credit card charge-offs. A default shows that you have not fulfilled your end of the loan contract, okay? And what about last one, filing? Oh, no, it's not the last one, but filing bankruptcy, impact or no impact?
Impact, definitely.
Yes, this is, and bankruptcy will devastate your credit score, okay? It's a good idea to seek alternatives like consumer credit counseling before filing for bankruptcy. Okay, last two. Actually, there's still more. Oh, okay. Rent payments, impact or no impact?
Rent
Impact.
payments? Yeah.
Impact, okay. So I think this is the same as some of the utility payments and the insurance payments. It's actually no impact. So paying your rent on time won't help your credit score. In fact, the FICO score would ignore the rental trade line even if it appeared on your credit report. On the other hand, falling behind on your rent could lead to an eviction, which would hurt your credit score and your ability to rent or get credit cards and loans in the future. So just like the other ones, it's not on-time pay. You're not getting an advantage of on-time payments, but you will be disadvantaged if you make your payments late and they end up being sent to creditors. Okay, so you don't want to do that. Checking your own credit. Impact or no impact?
Impact.
Not unless
Yes.
you use Credit Karma.
Correct, Dominic. That is the right answer. So no impact. Okay, if you can check your credit report as many times as you like and your credit score won't drop a single point as long as you check it through a reputable source like annualcreditreport.com, those apps like Credit Karma, at some the credit bureaus, FICO, or a legitimate third party. Okay, and that's the legitimate third parties, those Credit Karmas, things like that. Having a lender check your credit score for you would appear as a hard inquiry, which would hurt your credit score, okay? The same way a new application would for credit would. So on your end, if you're checking your credit score and you're looking at Credit Karma or you're looking at your annualcreditreport.com or you're looking at the credit bureaus, that's not going to hurt you. But if a lender is looking and checks, that's considered a hard inquiry. And remember how I talked about you don't want to be making too many hard inquiries within a year. You want to space those out with at least 6 months because your credit score is going to drop when you make any type of hard inquiry. So remember we talked about going to the bank and a bank that you already work with or another financial institution that you already work with and getting that line of credit already set up before you go look for a house, before you look for a car, okay? Because then if you go to the car dealership or you go to a mortgage place, they might just be sending out inquiries to a lot of different creditors or lenders, and that's going to hurt your credit score, okay? Having your home foreclosed. Impact or no impact?
Impact.
Definitely, right?
Because it shows that you're not responsible at keeping your own home and making those payments.
Right, and keeping your end of the bargain of the contract that you entered into with that lender, right? So
Yes,
getting behind on your mortgage payments will lead your lender to foreclose your home. In turn, the late payments will hurt your credit score and make it harder to get approved for mortgage loans. Your interest rate, does that have an impact or no impact?
No impact.
Okay, right, Robert. No impact. So having high interest rates on your credit cards and loans won't hurt your credit score. Neither will low interest rates improve your credit score, but there could be a correlation between credit scores and interest rates since lenders typically give the best rates to borrowers with the best credit scores, right? And your credit score influences your interest rate and not the other way around. So, say you don't have your credit established or you have something and you enter into a high interest rate credit card or a high interest rate car loan, that interest rate is not going to negatively affect you, but having such a high interest rate will make your payment a lot higher, and that might affect you paying your bills on time. So we still need to be thinking about that, okay? Credit counseling, does that have an impact or no impact?
I think no impact.
No impact, right, Brock? Okay, so one of the myths about credit counseling is that it's just as bad for your credit as Chapter 13 bankruptcy. That's not true, okay? Though credit counseling may be reflected on your credit report, it won't hurt your credit score. If a credit counselor is managing your credit card payments, you must make sure your creditor is getting your payments on time. Late payments hurt your credit score even if they're coming from a credit counselor. So you want to, if you're working with a credit counselor, you want to make sure that you can trust that person, okay? Closing old credit cards. And this is an interesting one. So think about this one. That's still Yeah, closing old credit cards. What do you guys think? Impact or no impact?
Impact.
Yes. Okay. Impact. 15% of your credit score is the length of your credit history. So longer credit histories are better. Closing old credit cards, especially your oldest card, makes your credit history seem shorter than it really is. Okay. What do you guys think about closing credit cards that still have balances? Impact or no impact?
You can do that?
Yeah, you can. But does it have an impact or no impact?
No impact.
It's actually does have an impact, okay?
Oh,
When you close a credit card that still has a balance, your credit limit drops to 0 while your balance remains. This makes it look like you've maxed out your credit card, causing your score to drop. Okay? So it's better to, if you have a credit card, to just not use it. Okay? Pay it off and just not use it and not close it. Okay? Because it lowers the amount of credit you have when you close it. And it also lowers your credit history, okay? So it's better just to pay it off and not use it, but don't close it, okay? Try to maybe work with the creditors about getting a lower interest rate after your credit score starts to improve and stuff. You could do that, but do not close it or just don't use it, okay? So having only credit cards or only loans, does that have an impact? Or no impact? Having only credit cards or only loans? Sorry?
Impact.
Impact. Yes, Kara. So a mix of credit is 10% of your credit score. So when you only have one type of credit account, either loans or credit cards, your credit score could be affected. This factor mostly comes into play when you don't have much other credit information in your credit history, okay? So you want to have different, you want to diversify. This is what, just like in businesses and stuff like that, you want to diversify. So you want to have different streams of money, right? Well, you want to have different streams of credit, okay? Because that makes you look like more well-rounded and your credit information is positively affected by that. Your age. Does your age have an impact?
yes.
You think so?
No, it does not.
Okay.
So that would be biased.
Exactly. Yeah, that would be biased. So your age isn't included in your credit score calculation, but there could be a relationship between your age and your credit score. If you're young, chances are you don't have much experience with credit, which could limit your credit score. Someone older with more credit history has time for early credit mistakes to drop off their credit card so they could have a higher credit score, okay? So we're trying to just really show you guys, since you're young, on when you start building your credit, just to be making the right decisions. So you know, you're already coming out the box, you know, running, right? You already have these tools in your toolbox to make sure that you're making the right decisions, and so that your credit score can be as high as possible, okay? So you'll secure those low interest rates and things like that, okay? So moving on, how to obtain your credit score. Okay, and we're still good on time, right? It's 10:30. I'm gonna try and get you guys off 10:55 so you can go to your other classes, the ones that you have another class, okay?
Okay.
So this topic discusses how to obtain your credit score. Some of the basics of this are the most commonly used credit score is known as a FICO score, and your FICO scores are ranked on a scale of approximately 300 to 900 points, okay? So here's how credit scores might be grouped. So 720 to 850 would be considered a excellent score. 680 to 719, and I've never really seen anybody with an 850 credit score. It used to be 820. My stepfather has excellent credit, and his credit score is like an 800. And the only reason why it went down from an 820 is because he hadn't gotten any loans in a long time. He had cars paid off, so he hadn't been using his credit. But 850, I mean, you really have to be doing a lot to get that kind of score, but it's not impossible. Okay, 680 to 719 is considered good. 640 to 679 is considered fair, and then 350 to 639 is considered poor, and then anything under 349 is usually that you just don't have any credit, okay, to even determine a higher score. So generally, the higher the score, the lower the predicted risk to the lender. And then you can obtain a copy of your credit score online for a small fee at www.myfico.com. And when applying for a loan, you want to ask your lender or creditor to explain what your credit score means in relation to the final credit decision. Okay? Because, you know, some lenders have different factors. They might work off of other types of credit or credit history besides your credit score. That would allow you to get a lower interest rate or even secure the loan, because sometimes you're just not going to get the loan. You're going to be denied because of the credit score, okay? And then never assume that your score is good or impaired until it has been fully explained to you by a credit industry professional. Okay. So how do we go into how to improve your credit score? So you always want to make sure that the information in your credit report is correct and manage your credit responsibly over time. Your credit scores reflect your long-term pattern of credit usage and repayment history. And credit scores automatically improve as your overall credit picture gets better. Okay? And there is no quick fix method to improving your credit score. You know how there are credit counselors out there, but that can fix your credit, that they claim to be able to fix your credit immediately and things like that, and that's just not true. There's no real quick fix. There's a lot of steps that you can take. When we talked about your credit report last week, looking at it, disputing charges, disputing things like that can help, and then just, you know, making your payments on time. You know, things like that can all help, but it's over a time period that you actually get a little bit better. And your credit score will get a little bit better. So no quick fix, okay? So be wary of places that say that they can overnight fix your credit score, okay? You just really need to be consistently paying your bills on time, okay? And you need to keep your credit card balances 70% or less of your spending limit. Okay, so we're going to move into a knowledge check. Maddie, are you on the line? No?
Yes, sorry.
Yes. Okay, you want to go over this?
Yes, ma'am. Okay. Hold on, it's because I can't really see. Of the factors listed below, what are used to determine your credit scores? What do you guys think? Payment history, income, amount of debt, types of credit in use, pursuit of new credit, or credit history? Which ones do you think? Of the factors listed below, what are used to determine your credit score?
Payment history.
Okay.
Credit history. Okay, good. Which one? What else?
Amount of debt.
Great. Okay, good.
Types of card in use. Credit in use.
Good. Okay.
Pursuit of new credit.
Fantastic. Dominic, you want to get the last one? So we have amount of debt, types of credit in use, pursuit of new credit, and credit history.
Wait, did someone say income?
No.
Can I
What-
say income?
You sure
did.
can.
All right.
You think income?
Yes.
Okay, so the correct answer was payment history, amount of debt, types of credit in use, pursuit of new credit, and credit history. Those were the 5 answers, okay?
Darn.
So again, remember, All of those are the ones that apply income. Just because you don't have a high income, as long as you're doing all of these other steps and regulating those positively, you know, you can have a positive outcome for your credit score and have a higher score, okay? So guess what? We have reached the module conclusion. Congratulations, you have completed the Understanding Credit Score module. Do you guys have any questions on this module?
Do we have homework for it?
I will be uploading an activity for you guys, and you'll get a notification for that, okay?
Yes,
You
ma'am.
guys did really well today.
Okay,
you
I'm
for
gonna go
interacting.
ahead.
Thank you.
I'm gonna go ahead and stop recording. Thank you guys for attending today, okay?
Thank you,
All
ma'am.
right, thank you, Miss.